So all eyes on the RBA tomorrow.
An early test for Michelle Bullock. Money markets see a 56% probability of a rate rise tomorrow. So on that measure, it's an each-way bet.
And interest rate rise tomorrow is tipped to slow the property market down.
If Michelle Bullock doesn't raise rates, is her credibility on the line?
It wasn't supposed to be like this. When Michelle Bullock was announced as the new Governor of the Reserve Bank a few months ago, analysts noted that she was taking over as interest rates seemed to have peaked. Her predecessor, Phil Lowe, had overseen the biggest rise in official interest rates in decades, and it seemed Bullock would be able to find her feet as the impact of rate rises already in the system slowed the economy, and she could concentrate on implementing reforms to the way the bank worked. But it hasn't quite worked out that way.
Inflation simply isn't coming down as quickly as the Reserve Bank thought, so they've had to do a little bit more, or at least we expect they will. And as long as we keep getting upside surprises on inflation, they will have to be asking themselves the question about how much more they need to do.
The most crucial change in the economy in recent months has been that inflation bounced back up in the September quarter, even though the annual rate has fallen. There have been some price shocks from events in the Middle East, but also some stubborn price pressures within the economy.
What we're seeing is inflation, particularly in services, so think health, education, arts and recreation. They're sticky and they're higher than what everybody thought. If the economy is still a little bit better than we all thought and unemployment stays lower than we all thought, it's a bit more difficult to see the RBA getting inflation back to 3% by the end of 25.
For the new Governor, there is the extra dilemma that the financial markets will be looking to tomorrow's decision as a crucial signpost to how hard she will fight inflation. The markets have priced in a 0.25% rise tomorrow as a near certainty.
I think the fact that markets are expecting it so strongly does make it difficult for communication if they were to hold rates. They would have to have a very clear explanation about how they think inflation is still going to get back into their 2 to 3% target range by mid-2025.
The Governor's rhetoric so far has certainly emphasised the focus on inflation.
The board won't hesitate to raise the cash rate further if there's a material upward revision to the outlook for inflation.
But it's complicated. Treasurers rarely intervene in anything to do with interest rates, but you could sense Treasurer Jim Chalmers' frustration last month with the task of wrestling the inflation genie back into its bottle, and an attempt to shape the debate about just how significant the higher inflation rate actually is.
The Reserve Bank looks for material changes in the inflation outlook. What we've seen today, and they will obviously assess these numbers in their own way, but what we've seen today is consistent with our expectations. It doesn't materially change the inflation outlook going forward.
I think everybody's entitled to interpret the data as they would like. There could be an argument that it's not material. Certainly our team was expecting something only a little below what actually happened, but the detail of the data didn't look good. There are a number of areas where inflation pressures are still much stronger than the Reserve Bank would like. And realistically, it's hard to say that it's immaterial given where they were 3 months ago.
Well, there is growing pressure on the Reserve Bank to lift interest rates further. The IMF has intervened.
Last week, the International Monetary Fund entered the fray, finding the inflation rate remains too high and recommending further monetary policy tightening. It's not just the Treasurer who is frustrated with the resurgence of inflation. Australian households are enduring their toughest cost of living crunch in decades. The number of households experiencing moderate or severe food insecurity rose from 33% in July last year to 36% in July this year, an extra 383,000 households. But despite this, retail spending was surprisingly stable over the same period and then rose 0.9% in September, the strongest growth so far this year. Mortgage rates are always in the headlines, but Australians are paying higher prices for many goods across the board and for services.
There was a few specials. One was Apple put out a new iPhone towards the end of the month, and things went up a lot there. And also the weather was a little bit better. And so therefore people went out and went to restaurants, etc. So it was a bit stronger, but by historical standards, this is a very weak period in terms of discretionary retail. It's just that if people want something, and whether it's Paul McCarthy, whether it's a new phone, they'll still do it.
At 1.66.
Then there's property prices.
It's not what you'd expect given the movements in interest rates, but population pressures and the fact that household size declined during the COVID period and is yet to reverse that out, these things seem to have added enough to demand that both rents and prices are really increasing rapidly at the moment.
The resilience of the economy in the face of the rate rises to date does seem extraordinary.
You've got weak economy, generating jobs, but not enough to fill in what's been happening in migration. So it's not that they're going to have a hell of a lot of firings, but rather it's just that the economy is sufficiently slow that it doesn't generate enough jobs.
For the government, the political task is convincing voters that it's doing something about rising prices. There's been a steady stream of announcements reminding people that Medicare benefits have been increased, childcare costs cut, and on the weekend, suggestions it would cut back on infrastructure projects to reduce price pressures.
Those $33 billion of blowouts from projects announced by our predecessors, and which factors in our inflation challenge. I do think we need to be upfront about that.
The problem for the government, though, and borrowers, is that recent events have once again opened up the spectre of even more rate rises to come, instead of the worst being over. It's not clear that announcements about infrastructure delays will do much to alleviate the dread that such expectations can stir up in an electorate which polls show is becoming more sullen by the day.